record. Okay, so let me pull up. I had technical issues my last class. My whole thing just freaking blanked out. But
Well, I have one question. I don't mean to
go ahead.
interrupt.
Go ahead.
So I'm currently like just catching up on weeks and stuff like that. Is that okay if I'm running late on some of this stuff, if I'm catching up on it all?
That's
All right.
fine.
Okay, thank
As
you.
long as you have it completed before the end of the semester, it's fine by me.
Thank you.
What I was talking about earlier was that you have until the end of the semester to sort of submit everything. And the question that was asked was, what do we do for the career presentation? Because the career project was supposedly already submitted for week 12, right? So that's where you answer those questions in week 7. You submit all that stuff in week 12 about your career. Now you need
Yeah.
to submit the presentation for week 15. So the presentation is you take that material that you did for your project, create it, put into a PowerPoint or Google Slides, upload those slides in week 15, and also have like a recording of yourself, either a YouTube video, Zoom video.
Because
Make
I'm just catching up on the weekly readings and the Excel assignments. Like I've been basically catching up on all that. I did the paper and everything that was due
Okay,
and all that.
that's good. The Excel is, like I said, is more important for you to do the Excel. It's not a huge part of the course in terms of grades.
Okay.
If you're trying to catch up and you're behind, I would focus, make sure you complete everything else first. You can leave the Excel for last. The last thing I was going to say is, your discussion boards, make sure you have your discussion boards completed, your connect assignments completed. And also your final is open already, but is due May 22nd, which is the very end of week 15.
Thank you.
Okay. And the final is essentially everything from week 8 and on in terms of your chapter studies. Okay.
Thank you.
All right. So I'm going to jump into chapter 17 for my lecture. I'll jump a little bit on some current events toward the end. But essentially, chapter 17 is about accounting. I, unless you're an accounting major, a lot of this stuff is something you won't really use or need to know. The definitions are important in terms of accounting, information about accounting. But if you're a business major and you're majoring in accounting, then all this information is very relevant. If you're not, the most important pieces of this aside of here is the balance sheet, the income statement is called the financial statements. So the financial statements are very important in business. It's very, very important. If you're a CEO, CFO running and managing a large multinational corporation, you need to understand how to read the financial statements. You don't have to know all the pertinent details about accounting, but you need to understand how to understand the financial statements. You need to be able to make sense of it. So a lot of this is just definitions you would need to know for the exam. But in terms of understanding, I'm going to go over just the things that I think are important for you to understand from a business standpoint. And that's going to be this financial statement. So you see here, financial statement, a summary of all the transactions that have occurred over a particular period. The key financial statements in business are the balance sheet, the income statement, and the statement of cash flow. The statement of cash flow is a little more confusing, but I'll get into that bit. The income statement here, which is in the middle, that's actually what comes first. That's the first thing you usually look at. Income statement is just how much money you made, how much money you spent. Did you make money or did you lose money, right? So it's profit and loss. The balance sheet is what you own or what you owe. So I own, a car, I own equipment, kitchen material, I own a printer, a computer. What does my business own? I owe a $50,000 loan that I took out for start my business, things like that. So the balance sheet is just looking at what you own, what you owe. The income statement is looking at what you made, what you lost. And the statement of cash flow is sort of reconciling your income statement in relationship to things that are decreasing or reducing potentially your income, but it's not real, which is confusing, right? So usually it deals with taxes and depreciation. That's the most common way. So what that means is, uh, let's say I made $100,000 in my business, right? And then I had $50,000 in expenses. So that means I physically made a $50,000 profit, right? But then I have to pay taxes. So let's say a third of that goes to taxes, right? So a third of $50,000 goes to taxes. What's left over would be my net profit. So there's pre-tax profit, which is how much I made before I pay taxes, and then my post-tax, my net profit after taxes would be two-thirds of 50%, right? So then you might say, okay, well, what is that? Right? How much is that amount? Then my accountant might say, well, hold on, let's not pay the IRS third of our income, right? The 50,000. We can take tax deductions. We can write off deductions. We can say we did this, we did that. So you can get more deductions. So maybe the equipment that I'm using, I'm depreciate the equipment. That means it's old equipment. I'm going to write down a loss against the value of the equipment. There's no cash going back and forth, right? I'm not buying and selling anything. It's a tax accounting thing you do. So on the statement of cash flow, when you're depreciating or writing down taxes, there's no cash exchange, right? It's just like a figment of the IRS's imagination of what you're saying is or isn't losing value. So statement of cash flow will reconcile how much money you really made versus how much went to taxes, things that are not actual cash, exchange of cash. It's more like we wrote this off or we wrote this down for tax purposes. The statement of cash flow will reconcile issues and also show your cash flow, right? It'll show what cash is really moving around. Because when you have a business, you can own real estate, right? Perfect example, 2008 financial crisis. If you had a business that owned real estate or lots of real estate, the value of your business could have went down in value because the real estate that your business owned lost the value, right? So if I own $1 million of real estate and it loses value because of a financial crisis, and now my $1 million property is worth $700,000, there is no cash exchange. Nothing happened cash wise. There's no flow of cash. I didn't pay $300,000 out. It's just paper loss, paper value. So on my balance sheet, I'm going to show a $300,000 decrease in the value of my real estate. But on the statement of cash flow and the income statement, there's no change of cash. I didn't pay 300,000. It's just the market changed. So the statement of cash flow helps with seeing the differentiation of what's actually coming in and out that's cash versus stuff that's being written off as a loss or an expense that's not really cash related. So that being technical. For you, income statement and balance sheet is probably the most primary things. So let's just go over income statement. All right. Right now they're looking at balance sheet, but we're going to jump on income statement. All right. Okay. So income statement, they say financial statements that show a firm's profit after cost, expenses, and taxes. It summarizes all the resources that come into the firm's revenue, all the resources that have left the firm, expenses, and the resulting net income or net loss. And it says the net income or net loss is the revenue left over after all costs and expenses, including taxes, are paid. So what that means is, let's say I'm selling hot dogs, right? So I sell $1 million. That's a lot of hot dogs. I sell $100,000 of hot dogs. I got to buy the buns, the dogs, the mustard, the ketchup, the condiments, the onions. I got to have a grill if I'm grilling my hot dogs because they probably taste better if I grill them, right? Grilling my hot dogs, the machines to keep them warm, buns, paper, real estate for my store, or if I have one of those mobile food things, a food truck, the cost of the food truck, my utilities, my heat, my gas, all that stuff, right? So all those things are the cost to run my business. So if I sold $100,000 of hot dogs and it cost me $70,000 to run the business, that includes the all the things I mentioned plus the labor, the utilities, all that stuff. I made 100,000. I spent 70,000. That means my net income is 30,000. That's what the income statement will show. It will physically show how much you made minus uh what your expenses are. And then you have a net income number, 30,000 in this example, then whatever taxes you pay, right? And that's what the income statement is showing you. So you can have a business that is losing money, right? You might say, oh my gosh, they're making $50,000 a year. Well, let's say they're making $50 million a year, but they're spending 51 million. So they're showing a $1 million loss, right? Then you go to their balance sheet and you're looking at what the business owns and what they owe. Business could have like a $250 million of real estate it owns full and clear. So you might say, oh, this business sucks because it's losing $1 million a year. But then you look at the business, it owns a ton of real estate and it has very little debt. So you say, oh, wow, right? So the balance sheet tells you a totally different story about the business. It's just showing you what the business owns, what it has, what are its assets, its liabilities, right? That's why assets plus liabilities equals owner's equity. That's the equation they give you. So it's what you own minus what you owe. That's what that is, equals owner's equity. So you could look at an income statement and it could show the business is making money or losing money. And the balance sheet could tell you something else. You could look at a business and they're making tons of money, tons of cash. Whoa, this is a cash making machine. And you look at the balance sheet and they have so much debt. You're like, ooh, they owe a ton of money. So, is that good? Is that bad? How long is it going to take to pay off the debt? So those things factor into the value of the business, the health of the business. So the balance sheet and the income statement, very many times, the financial statements in general, they play an important role in you being able to ascertain the financial health and well-being of the business. Similar to you going to the doctor and getting a checkup, a physical checkup, checking your blood work, your health, looking at the financial statements of the business is like getting a checkup, right? So if you understand what to look for, you can make sense of it. The more complicated the business, the more difficult it is to make sense of it because there's a lot of stuff going on. So usually a big Fortune 500 company or just a large corporation will have something called a 10K. You look at it, it's got all that information and more, and you can go into it because there's a lot of artwork or art. The art of accounting is unique, right? Some businesses could say what they want to say as long as they express what is being said on their 10K, and you have to make sense of that. But that's an accounting thing. You don't have to worry about that too much. And that's it. Okay, so I just wanted to go over those key aspects here. Uh, I just want to show you this income statement. So I want to show you uh, statement of cash flow, the definition here. It says financial statements that report cash receipts and disbursements related to a firm's three major activities. So the three major activities are operations, investments, and financing. So, for example, a business can finance a purchase of a piece of property, of equipment. It can invest, it can buy CDs, stocks, bonds. It can invest in different things. Uh, when you're analyzing the statement of cash flow, you're looking at the differences between cash actually coming in and cash actually going out of the business. So those statements of cash flow help you kind of to discern um, that aspect of it, which I tried to explain the technicality that the statement of cash flow makes the most sense when you start to look at tax stuff. You'll very quickly see, oh, that's not on there. This is on there. But for you just need to know the definition, right? There's definitions here, liquidity ratios, leverage debt ratios, things of that sort. It's just and those ratios, by the way, are help give you measurement. It's kind of like a doctor running a test, a blood work on your test, a test on your blood work to figure out if you have high blood pressure or blood pressure, if you have high cholesterol, or if your blood sugar is high. You can think of it similarly to running these type of ratios to help you understand characteristics of the business. Is the business have too much debt? Does it have good cash flow? Does it make good income? Those ratios give you an idea about quick metrics of the business. And those are equations. You probably don't need them. You don't need to memorize those equations. You just have to understand the basic definition of those equations. Uh, Let me go back to sharing. Well, we don't have to. We're finished with this. I don't have to share the screen. Before I continue, do you guys have any questions on what we went over right now, or you guys are good?
I'm good.
Okay. So, if you were an investment banker or you're doing mergers and acquisitions, and you're like, oh, I want to buy a business. I'm an entrepreneur. I want to buy a business. I want to flip a business. That's what private equity firms do. I want to flip that business. This is what you're looking at. You're looking at the financial statements. You're looking at their tax statements. You're probably talking to an accountant to say, hey, what is this? What's going on? Uh, if they'll let you. Uh, and You're getting an idea on the health and wellness of the business to figure out what's going on. And the thing is that this is all a lot of this is public information. If it's a large corporation, it's public information. If it's a private company, it's private. You won't know what's going on with their taxes. You can't see it. But if you went online and you looked at McDonald's, you could see their income statements. You could see their balance sheet. You can see their statement of cash flow. You can look at it, you can analyze it. That's what analysts do. Financial analysts, they look at financial documents, financial statements. They look at the company's financial data. They do forecasts. They look at the market. They look at potential future earnings. They look at a lot of research. They do research on the business. How they do the research depends on how they get the data, right? Sometimes you can get data because of connections. Sometimes you get data because you have access to data, and try to figure out what's going on. Usually, the company itself will have its CFO and its team do what they refer to as a projection of their company. First quarter, second quarter, third quarter, fourth quarter projection. They'll say, we'll project we're going to make 1% more, 2%. We're going to beat earnings. So analysts will make a projection and the company will make a projection of their numbers, and it's kind of like what the analysts say versus what the company says. And sometimes they actually project their own numbers, and they do much better than what they say. Oh, we're going to make 3% over last quarter, and then they make 5%. And then you see the stocks jump up because they beat their earnings, right? People buy it, things of that sort. So all that information that we went over, the financial statement is very critical to sort of assessing uh, these numbers are critical to assessing a company's health and well-being. So in current events, we can see some interesting things. You remember last time we spoke, I mentioned about gold. Do you remember what the price of gold was the last time we spoke, guys?
I
Well,
actually don't remember exactly what it was. It's
uh,
going up though.
yeah, it's going up, right? What did I say? It's going to go up.
It's gonna keep going up.
Yes, it was at 3,400 at one point. It's back down to 3,200. JP Morgan Chase, they're the bank, JP Morgan Chase Bank. They're forecasting that gold can go up to 4,000 over a long term, which is pretty crazy. That's good and bad, right? I would say it's a bad indicator because people are fearfully buying gold, thinking that the U.S. economy, the U.S. currency is in jeopardy. So they're buying gold as a hedge against increase of inflation. So gold is usually purchased when people think there's going to be rise in inflation. They buy gold. And they think there's going to be fear of economic turmoil. They buy gold. That's been kind of what's been happening, plus all the commodities turmoil with President Trump and his you know uh stuff going on with the trade wars, his tariff wars with China and so on and so forth. So there's a fear of inflation, the rising cost of goods and services increasing, and it affecting American consumers because of that. So there's a lot of traction going on in gold. It's continuing to rise. I mean, just imagine if you picked up gold. Remember we were in class, I showed you guys you could buy gold, and it was cheaper then, right? It was like 2,700, 2,800. Now it's 3,200. So just imagine, you picked up a couple of bucks of gold, you make a couple of bucks, right? So I always say that these things are very relevant. The definitions you're learning, the information, the business stuff you're learning, it's not just definitions. It's real life, it's real world stuff. I don't have a crystal ball. I'm not a magic soothsayer. I don't have a guess. I don't say, oh, I guess it's going to increase. I'm not guessing, guys. It's just the economics. It's just this is what happens, and this is what goes up, and this is what goes down, and this is what happens when this, and this is that's all it is, right? It's just like you eat a lot of fatty foods. You wonder why your cholesterol is high. You eat a lot of sugar. Why do I have diabetes? Most of that's inflammation based, believe it or not. But never mind that. So there's a cause and effect for the things that happen, right? If Donald Trump says we're going to put trade wars against other people, guess what's kind of other countries? What happens? Right? You're gonna cause a squeeze, an inflationary squeeze. You're gonna cause a fear, an initial fear mongering, which is what happened initially. People are afraid they're gonna have a lack of supplies because they'll have to pay more, so they quickly ordered bulk supplies. Kind of like if you think toilet paper is going to run out, you go to the store and you just buy a lot of toilet paper, right? It's going to get more expensive. I'm going to go to Costco. I'm going to buy lots of toilet paper and lots of, whatever I think I need because the cost of stuff is going to go up, and if I get a whole bunch of it now, I can ride the wave before, during this time. So that's what businesses did. They literally purchased a bulk supplies in anticipation of the fear of Donald Trump's tariffs, which caused an immediate spike and fluctuation in commodity goods in the futures market, followed by it crashing because of him going back and forth with crashing and rising because of him going back and forth with putting reciprocal tariffs and pulling back the reciprocal tariffs for 90 days and then saying he's gonna ease this and then no, I won't apply it for this and I'll apply it for that, back and forth, back and forth. And China's like, we don't care. We're not gonna budge. So now you got China. China, I think I read somewhere they something pork, was it pork? I think they canceled all their orders with America for pork and they're ordering it from some other country now. So, China is a very big importer of meat, beef, pork from America, because the Chinese middle class has been increasing and rising and for many years. So as you see more of the middle class increase, you see more of an appetite for maybe like a first world Western diet where people want more meat instead of more vegetable, more grains because it's cheaper. All vegetable source of protein. They want animal protein, which is more expensive. So you see that increase, the rise in demand as people's income and salaries increases. So China's been importing a lot of American meat. But since the trade war, China's like, nah, we don't want your pork anymore. So they literally they're not, they stopped because of the tariff, reciprocal tariffs. So I think they're ordering it from somewhere else now because I guess it's cheaper, right? It's cheaper now. If it was a good deal in America, it's no longer a good deal. So you've got that industry that there's going to be sort of like a little shock where they're going to have a lot of excess supply, pork supply, that would have went to China that's not going to China. So now that supply, the demand for that supply is not being met because of the tariffs. So you'll have this like chunk of pork floating around and no one's buying it. So then it's going to have to get either they'll have to find new buyers. Now, of course, this whole tariff thing can just be blown off tomorrow. Trump could just wake up one morning and say, "Oh, I signed an executive order, no more tariffs," right? And there's no more tariffs. So that could happen, right? So you have to think, well, is this temporary? Is it not temporary? Is it a 90-day hold on this and that? But generally, though, if there's a lot of product and the demand is not being met, that product then probably gets sold elsewhere for cheaper. So then you'll see as more supply hits the market because that supply wasn't sold by China, you see initially a price drop in the product because there's more supply than demand. So you'll see actually it'll probably get cheaper initially, believe it or not, which is bad for the farmers because they're losing money, right? Because they're not selling it to China at their profit. So the consumer might say, "Oh, cheap pork, great," but the industry that's making it is losing money, so that's bad for their profits, and then when it's the next season, they're going to cut their supply, so they're going to curb back on the manufacturing of their pork because now they don't have China uh, buying the product because they're buying it elsewhere. So then you're going to actually see a decrease in their supply. So they're going to create less pork product. So you'll see prices go back up again, um, or maybe even higher too, because maybe their feed or wherever they're getting their resources to feed their animals, there may be a pinch on their supply chain, so prices may go up as well with that. But for the most part, you would then see them retract and pull back. So the pork suppliers now would produce less pork to offset the fact that China is no longer buying from them. But this could be temporary. So what do they do? Do they reduce supply? Do they maintain supply current for the future? So it's complicated, right? So they're playing this guessing game of, well, what do we do? So that's why all this tariff stuff is really tricky because it's now, it's short term, and it could be long term or it may not be long term, right? What if Trump just decides to just cancel all this tariff stuff and that's it? He did his wheeling and dealing and he feels good now that the country got the deals it wanted to do. Now you spend all this money readjusting your supply chain, time, resources, figuring out new buyers and suppliers, and China cutting loose your deals, and then you cutting back on your production to offset the fact that you don't have China, and then tomorrow, oh, tariffs are off. We could just start selling them again. But you made all these long-term decisions or near-term decisions that cost you money. That's hard to unplug to reset, right? Because you have to start raising cattle. Sorry, raising swine and cattle. Swine in this case, I think pork. It's not like you just snap your fingers and you got a fully grown cow. It doesn't work that way, right? There's a chain of growth and cycle with the animal. So you might have to, reduce the amount of animals that you're raising for the next season because anticipation of something, or do you make more and just hope that Trump drops it? So much uncertainty, and it's putting so much pressure and strain on businesses. Consumers haven't even realized the effect of what this will have on them in the short term, the near term, the long term, and so on and so forth. The only thing you can do is just go like this. I don't know what to do. But what people will do is they'll buy gold because when you're not sure or you're unsure about a situation, people buy gold out of fear. So that's why gold is on the rise. So that's why I say to you is all these little nitpicky things, that. Just buy gold, right? Because that's what they're going to do is they're going to flee in fear into gold. So our class lecture is over. We will have one more lecture next week, and then that's it. After our last lecture, you're preparing for your finals, your final project, and then clearing up any other work you have to do. You guys have any questions before we jump off?
Thank you.
All right. So I'll let you guys go. If you have any questions, just shoot me an email.
Thank you so much. Have a good day.
Take care, everybody.